The stock market celebrated record highs on October 23, 1929. The very next morning, it began the most devastating financial collapse in recorded history. Millions of ordinary Americans had borrowed money to buy stocks. When prices fell, they could not pay back the loans, and the entire system cracked from the inside. Welcome to the Market Antiquarian, where history and finance reveal how the world really works. Subscribe to stay informed. There is a pattern hiding inside the numbers of 1929, and that same pattern is drawing itself again across the financial markets of 2025. In 1929, the Dow Jones Industrial Average had risen nearly 500% in just 8 years. Crowds gathered on Wall Street daily, convinced the rise would never stop. Newspaper headlines in New York City called the stock market a guaranteed road to wealth. Shoeshine boys were giving stock tips to businessmen on street corners. When ordinary people with no financial training begin speaking like experts, history has shown that a dangerous peak is forming somewhere just above the horizon. In 2024, the United States stock market climbed to record highs while household debt reached $17.5 trillion, the largest total ever recorded in American history. Traders in glass towers on Wall Street watched their screens glow green day after day, and the mood across trading floors felt almost identical to the autumn of 1929. The word margin changed everything in 1929. Investors were buying stocks with only 10% of the real price, borrowing the remaining 90% from their brokers. A man in Chicago could walk into a brokerage office with $100 and control $1,000 in stock. The profits felt enormous. The risk was invisible. Margin debt in the United States stock market reached over $800 billion in 2024. That is more borrowed money chasing stocks than at any previous point in history. When prices rise because of borrowed money, and not because of real economic growth, the entire structure sits on a foundation that dissolves the moment. Confidence disappears. On Black Thursday, October 24, 1929, the New York Stock Exchange opened and prices began falling. Brokers started calling in their loans. Panic spread across the trading floor. Traders stood shoulder to shoulder at the New York Stock Exchange, shouting orders that nobody was filling. For the first time in a generation, the buyers had vanished completely. By the time the closing bell rang on October 29, 1929, nearly $14 billion in stock market value had been erased. Crowds stood silently outside the exchange building. That single week of losses in 1929 is equal to over $250 billion in today's money. Fortunes that took decades to build disappeared in hours across America. What made 1929 truly devastating was not just the stock market. It was what the crash did to the banks that sat quietly behind every trade being made on Wall Street. Banks in 1929 had lent enormous sums to brokers who had lent those sums to investors who used them to buy stocks. Every layer of the chain was connected to the next. When stock prices collapsed, investors could not repay brokers. Brokers could not repay banks. Banks began running out of cash. The failure moved like fire through dry wood. In 2023, Silicon Valley Bank collapsed in 48 hours after customers withdrew $42 billion in a single day. Bank runs had returned to American soil for the first time in decades. The federal government stepped in quickly in 2023, but the speed of that collapse revealed something important. The connection between banks and financial markets had not changed since 1929. During the 1920s, a new financial product was spreading across the United States. It was called an investment trust, and it promised ordinary citizens access to professional stock portfolios. Investment trusts borrowed money to buy stocks in other investment trusts, which had borrowed money to buy stocks in yet more investment trusts. The layers were almost impossible to count. In 2025, exchange-traded funds hold trillions of dollars, and they buy shares in other funds which hold shares in overlapping companies. The structural similarity to 1929 is exact and measurable. When one fund begins selling because of losses, it forces other funds to sell, which forces more funds to sell. This chain reaction is called a cascade, and it begins quietly. The Federal Reserve raised interest rates 11 times between 2022 and 2023, the fastest and most aggressive rate increase campaign since the tightening that preceded the crash of 1929. In 1928, the Federal Reserve raised rates to cool what it described as excessive speculation. Historians now agree that this tightening helped trigger the catastrophic collapse 1 year later. The parallels between the monetary decisions of 1928 and those made between 2022 and 2024 have been discussed in financial journals at universities across the United States and Europe. real estate in the United States during the 1920s was experiencing a separate bubble that had already begun to burst before the stock market ever collapsed in October of 1929. The Florida land boom of the mid-1920s saw swampland being sold to investors in New York who had never visited the state. Prices doubled and tripled within single years. When the Florida real estate market collapsed in 1926, it wiped out banks across the southern United States and quietly weakened the national financial system 3 years before the famous crash. Between 2020 and 2022, home prices across the United States rose by over 40%. Cities like Phoenix and Austin saw prices double in under 2 years of trading activity. Real estate investors were buying houses without inspections, without seeing them in person, and without any plan other than selling them to someone else at a higher price the following month. By 2024, mortgage delinquency rates were climbing in the United States, and commercial real estate values in major cities were falling sharply as office buildings sat empty across downtown districts. The commercial real estate market in 2024 carried over $1.5 trillion in loans that needed to be refinanced at interest rates far higher than the rates when those loans were first written. Banks holding those loans faced a quiet but serious problem. The properties backing those loans were now worth less than the loans themselves, a condition that financial historians call being underwater. In 1929, the phrase being underwater did not exist yet, but the condition it describes was present everywhere across the American banking system during the final months before the October collapse. There is a concept that economists call wealth effect. When people feel wealthy because their investments are rising, they spend more money. That spending feeds economic growth and makes the market rise further. During the 1920s, the wealth effect ran at full power across America. Consumer spending was surging, car sales were breaking records, and radio manufacturing was expanding at an extraordinary pace nationwide. Between 2020 and 2024, United States consumer spending hit record levels, car prices rose to historic highs, and technology company valuations reached numbers that had never appeared on Wall Street before. The wealth effect works beautifully when asset prices are rising. It works in reverse, with equal and devastating power when asset prices begin to fall for the first time in years. In 1929, the largest corporations in America were General Motors, Radio Corporation of America, and United States Steel. Their stock prices had risen so high, they seemed to exist beyond any earthly value. Radio Corporation of America, known simply as RCA, saw its stock price rise from $85 in 1928 to $549 by early 1929. It had never once paid a dividend to shareholders. In 2024, Nvidia, Apple, Microsoft, and Amazon were collectively valued at more than the entire gross domestic product of Germany, France, and the United Kingdom combined together in a single year. When a small number of companies represent an outsized share of the entire market, a decline in just those few companies can pull the entire index downward with extraordinary and sudden force. In 1929, the top 10 stocks represented nearly 30% of total market value on the New York Stock Exchange. When those 10 began falling, the entire market followed them directly downward. In 2024, just 7 technology companies represented over 30% of the total value of the Standard & Poor's 500 index, the most concentrated market position since the records of 1929. Concentration at the top of a market is not merely a statistic. It is a warning embedded in the architecture of the market itself, visible only to those who know what they are looking at. The ordinary American worker in 1929 was largely excluded from the stock market boom that made millionaires out of the wealthy. Factory wages had barely moved throughout the celebrated decade of prosperity. While stock tickers clicked upward in brokerage offices across New York, steel workers in Pittsburgh and cotton farmers in Mississippi watched their own incomes remain almost completely flat year after year. The gap between the wealthy investor class and the working population in 1929 was wider than at any point since the Civil War. According to economic studies of that period, published later, by 2023, United States wealth inequality had reached levels not recorded since 1929. The top 1% of Americans owned more wealth than the entire middle 60% of the population combined. Income inequality does not cause a market crash directly, but it creates a brittle economy where any disruption hits the majority of people with devastating force and almost no financial cushion. When most people carry no savings and high personal debt, A single job loss or a single spike in interest rates can cause them to stop spending entirely within weeks of the event. In 1930, after the crash, consumer spending collapsed across the United States. Factories began laying off workers. Those workers stopped buying goods. More factories closed. The cycle fed itself downward relentlessly. Economists refer to this downward cycle as a deflationary spiral. Prices fall because nobody is buying. Wages fall because companies cannot make profits. More people stop buying because wages have fallen further. The Federal Reserve in 1930 and 1931 raised interest rates in the middle of a collapsing economy, a decision that economic historians describe as one of the most consequential errors in financial history. Milton Friedman and Anna Schwartz documented this error in their landmark 1963 work, A Monetary History of the United States. Their research transformed how central banks think about economic crisis management globally. Federal Reserve Chairman Ben Bernanke stood at a dinner in 2002 honoring Milton Friedman and said, "You were right, we did it, and we are very sorry," acknowledging the errors of the 1930s era. That acknowledgement became policy. When the financial crisis of 2008 arrived, the Federal Reserve flooded the system with money rather than tightening it, a direct lesson drawn from the failures of 1929. But there is a question that financial historians are now asking with increasing urgency. Did the response to 2008 simply delay a reckoning rather than resolve the underlying structural problems creating instability? After 2008, the Federal Reserve held interest rates near zero for 7 years. Cheap money poured into stocks, real estate, and corporate bonds, inflating asset prices across every category of investment simultaneously. The total assets held by the Federal Reserve grew from $900 billion in 2008 to nearly $9 trillion by 2022. That is a tenfold expansion in the size of the central bank balance sheet. When central banks expand their balance sheets on that scale, they are effectively printing new money and sending it through the financial system. The 1920s had a similar period of monetary expansion. The United States gold reserves at Fort Knox backed every dollar in circulation during the 1920s, but the Federal Reserve was still able to expand credit in ways that fueled speculative excess across markets. The International Gold Standard created a web of financial dependency in 1929 that meant when the United States sneezed, Britain, Germany, France, and Argentina all caught pneumonia within months of each other. In 2025, global financial markets are more interconnected than at any previous point in human history. A crisis that begins in one country can reach every other market within hours through digital trading systems. During the 1929 crash, news traveled by newspaper and telegram. It took days for the full scale of the disaster to become clear to investors in London or Paris or Buenos Aires today. Algorithmic trading systems in data centers across New Jersey and London react to news in microseconds. A single piece of negative data can trigger automatic selling across 50 markets simultaneously. The speed of modern markets does not reduce risk, it concentrates and accelerates it. What took 3 years to unfold between 1929 and 1932 could theoretically compress into a much shorter period today. Herbert Hoover stood before the American public in October 1929 and told them the fundamental business of the country was on a sound and prosperous basis. The market fell further the following day. There is a historical phenomenon that economists call the Hoover mistake, which describes what happens when government officials publicly deny the severity of an unfolding financial crisis to prevent additional panic selling. The denial often creates the very panic it was designed to prevent, because when the reality finally becomes undeniable, the collapse of confidence is far more severe than it would otherwise have been. In the months before October 1929, the most respected financial voices in America were publicly dismissing concerns about market valuations. Irving Fisher of Yale University called prices permanently high just weeks before the crash. Fisher had developed serious economic theories that remain studied in universities today. His personal investment portfolio was largely destroyed in the crash. He spent years afterward trying to repay his debts. Expertise does not protect against a crash. Confidence does not prevent a crash. The crash moves according to its own structural logic, and it arrives when the weight of borrowed money becomes impossible to carry. By 1932, the Dow Jones Industrial Average had fallen 89% from its 1929 peak. An investor who put in $1,000 at the top needed until 1954 to recover the full original amount. That is, 25 years of waiting. 25 years of watching a portfolio remain below the price paid. 2.5 decades of financial consequence flowing from one period of excessive market speculation and borrowed money. The human cost of the Great Depression that followed the 1929 crash was measured not only in dollars but in breadlines stretching around city blocks in Chicago, Detroit, and New York City. By 1933, 25% of the American workforce was unemployed. Families left their homes and drove west toward California in search of work that was equally scarce on the other side of the country. Photographs taken by Dorothy L. Lenga in California during the 1930s show families living in tents near agricultural fields. Those images became the permanent visual record of what financial collapse looks like at the human level. The suffering of the 1930s was not inevitable. It was the consequence of specific decisions made by specific institutions during the preceding decade of unchecked speculation and borrowed prosperity on Wall Street. Every market cycle carries within it the seeds of its own ending. The question is never whether the cycle will end. The question is always how far from reality prices have traveled before they do. In 2025, price-to-earnings ratios on United States stocks are sitting near the same elevated levels they occupied in September of 1929. According to data compiled by economists at Yale University, Robert Shiller, the Nobel Prize-winning economist at Yale University, developed a measurement called the cyclically adjusted price-to-earnings ratio, which compares current stock prices to 10 years of average earnings. In October 1929, the Shiller ratio was near 30. In the year 2000, before the dot-com crash, it reached 44. In 2024, it climbed above 35 and remained there through the first months of 2025. These numbers do not predict the exact timing of any event, but they tell us something important about the distance between where prices are and where the underlying economy actually sits. In real terms, history does not repeat itself in exact detail, but it rhymes with such precision that those who have studied the patterns can hear the familiar melody playing beneath the noise of the present moment. The story of 1929 is not finished. It is still being written in the trading floors and government buildings and kitchen tables of 2025. The next section will show you exactly how deep the pattern goes. In 1929, the warning signs were visible for nearly 2 years before the collapse. Most people chose not to see them because the profits felt too good to question or walk away from. That is not a character flaw. That is human nature. And human nature has not changed 1 single degree between the autumn of 1929 and the financial markets operating in 2025. The story picks up where the numbers left off. Behind the statistics are decisions, institutions, and patterns of behavior that connect 1929 and 2025 in ways that go far deeper than coincidence. One of the least discussed causes of the 1929 crash was the role of tariffs. In 1930, the United States government passed the Smoot Hawley Tariff Act, raising taxes on over 20,000 imported goods. Other countries retaliated immediately. Trade between nations collapsed by nearly 66% between 1929 and 1934. Factories that depended on foreign markets lost their customers and began closing across the country. In 2025, the United States government announced sweeping tariffs on goods from China, Europe, Canada, and Mexico. Trading partners began announcing retaliatory measures within days of the initial announcement being made. Economists at major universities and financial institutions began drawing direct comparisons to the Smoot Hawley era in public statements and published research papers circulated across the financial community. In early 2025, trade wars do not stay contained to the countries that start them. They spread through supply chains, raise prices for consumers, reduce corporate profits, and slow the economic growth that holds markets up. In 1929, American farmers were already struggling before the crash arrived. Crop prices had been falling throughout the 1920s, as European agriculture recovered from the destruction caused by World War I. Farmers across Kansas, Iowa, and Nebraska had borrowed heavily to buy land and equipment during the wartime boom. When prices fell, they could not service those loans, and rural banks began failing quietly. Over 600 banks failed in the United States in 1929 alone. Most of them small rural institutions in farming communities that nobody in New York or Washington was paying close attention to at the time. In 2023 and 2024, agricultural loan delinquencies in the United States Midwest began rising. Farm equipment repossessions increased. Rural community banks reported stress in their loan portfolios for the first time in years. The problems at the edges of an economy are often the earliest signal of what is coming toward the center. The farmers of 1929 knew something was wrong long before Wall Street admitted the same. Charles Mitchell was the chairman of National City Bank in 1929, one of the most powerful financial institutions in the United States. He told reporters in March 1929 that the market was perfectly sound. National City Bank collapsed in 1933. Charles Mitchell was investigated by the United States Senate for securities fraud. His public reassurances in 1929 are now studied as a textbook example of institutional denial. The Senate Banking Committee hearings of 1933, led by Ferdinand Pecora, revealed that the largest banks in America had been selling their own customers worthless securities while privately betting against those same products. Pecora held those hearings in a wood-paneled Senate chamber in Washington, D.C., and called the most powerful bankers in America to testify under oath before the public and the press simultaneously. The testimony that emerged from those Senate chambers changed American financial law permanently. The Glass-Steagall Act of 1933 separated commercial banking from investment banking for the next 66 years. Glass-Steagall was repealed in 1999. Within 9 years, the financial system experienced the largest crisis since 1929, as banks that were both commercial lenders and investment traders collapsed under the weight of bad bets. The lesson of 1933 was learned, written into law, preserved for 66 years, and then quietly dismantled by legislation that the financial industry had spent years lobbying. Congress to pass on Capitol Hill, this is one of the most important and least discussed dynamics in financial history. The systems built to prevent disasters are gradually weakened during periods of prosperity, when the memory of disaster begins to fade. Alan Greenspan served as Federal Reserve Chairman from 1987 to 2006. He believed that financial markets were self-correcting and that excessive regulation prevented the innovation that created prosperity across the American economy. Greenspan testified before Congress in October 2008 and admitted that his belief in the self-regulating nature of markets had been wrong. He described finding a flaw in the model he had relied upon for decades. That moment of admission, delivered in a congressional hearing room in Washington, D.C. by the most influential central banker of his generation, echoed the silence that fell over Wall Street in October of 1929. In 1929, the phrase "too big to fail" did not exist. Banks were allowed to collapse. Depositors lost their savings. Families walked into bank lobbies across the country and were told their money was gone. After 2008, the United States government used public funds to rescue financial institutions that were deemed too large to be allowed to fail. The total cost of those rescues exceeded $700 billion. The rescues of 2008 prevented an immediate collapse, but created a new problem. Financial institutions understood that the government would intervene if they became large enough, reducing the natural incentive to manage risk carefully. Economists call this dynamic moral hazard. When the consequences of a bad decision are removed, the frequency of bad decisions increases. This principle now sits at the structural center of modern financial markets. By 2024, the 5 largest banks in the United States were significantly larger than they were in 2008, when they were already considered dangerously large by financial regulators and members of Congress. The concentration of financial power in a small number of institutions creates a system that is simultaneously more stable in normal times and more catastrophically fragile when conditions change without warning. In 1929, individual investors buying stocks on margin were the primary source of speculative excess. In 2025, that role has been partially replaced by algorithmic trading systems managing trillions of dollars automatically. These algorithms are designed to reduce risk through speed and diversification. But when many algorithms are programmed with similar logic, they can all begin selling at the same moment for the same reasons. On May 6, 2010, the United States stock market fell nearly 1,000 points in minutes before recovering. The event became known as the flash crash and was traced directly to automated trading systems reacting simultaneously. The flash crash lasted 36 minutes, a sustained version of that same dynamic, triggered by a genuine economic shock rather than a technical error, represents one of the most discussed risks in modern financial markets. In 1929, information traveled slowly. A trader in San Francisco might not know the full scale of what was happening on the New York Stock Exchange floor until the following morning newspaper arrived. Today, financial news reaches every market on Earth within seconds. Social media platforms can turn a rumor into a bank run before any regulator has the time to issue a single public statement. The collapse of Silicon Valley Bank in March 2023 was accelerated by messages shared on private group chats and social media platforms, encouraging depositors to withdraw their funds as quickly as possible. Regulators later confirmed that the speed of the digital bank run was unlike anything they had modeled in their stress testing scenarios. The bank lost $42 billion in deposits within a single business day. In 1929, a bank run required people to physically stand in line outside a building. Today, it requires only a smartphone and a few seconds of time to initiate a transfer from anywhere on Earth. The infrastructure has changed entirely. The human behavior driving it has not changed at all. Fear moves money today with the same logic and the same speed of emotion that it did in 1929. One of the most striking parallels between 1929 and 2025 involves the role of new technology in driving speculative excess beyond what traditional valuation methods could justify or explain to ordinary investors. In the 1920s, radio and electricity were the transformative technologies. Companies involved in those sectors attracted investment regardless of whether they were actually profitable or had a realistic path to sustained earnings. Radio Corporation of America had almost no earnings when its stock price reached $549 in 1929. Investors were paying for the promise of what radio might become rather than what it had already built. In 2023 and 2024, artificial intelligence became the transformative technology driving investment. Companies that mentioned artificial intelligence in their quarterly reports saw their stock prices rise regardless of their actual current profitability. NVIDIA saw its stock price rise over 200% in 2023 as demand for artificial intelligence processing chips drove expectations of future earnings that dwarfed anything the company had previously reported to shareholders. Expectations of future technology have driven speculative excess in every major financial bubble recorded in modern history. From Dutch tulips in 1637, to railroad stocks in 1846, to internet companies in 1999, the technology changes with each cycle. The psychology driving the investment does not change. The belief that this time is different is the single most dangerous sentence in the history of financial markets. John Kenneth Galbraith wrote his landmark study of the 1929 crash in 1954. He described in precise detail the mechanisms of speculative psychology that caused ordinary people to abandon judgment during periods of rising prices. Galbraith noted that the crash was not caused by one bad decision or one corrupt institution. It was caused by a collective suspension of critical thinking across an entire society during a period of shared optimism. That suspension of critical thinking is not unique to any era or any country. It emerges whenever rising prices create the social pressure to participate before it is too late to benefit from the gains. Fear of missing out is not a phrase invented by social media. The emotion it describes was documented in newspaper accounts from New York City in 1928, as ordinary citizens rushed to open brokerage accounts. Barbershops in Manhattan in 1928 had stock tickers installed so customers could watch prices while getting haircuts. The market had become a cultural event, not just a financial instrument for professional investors. In 2021, retail investors using a smartphone application called Robinhood drove the price of GameStop stock from under $20 to nearly $500 in a matter of days through coordinated online activity. Financial regulators, hedge fund managers, and members of Congress were caught completely off guard by what happened. The rules written after 1929 had not anticipated this particular form of speculative participation. The GameStop episode was treated as an isolated curiosity by many analysts, but it revealed that the democratization of market access through technology had created new pathways for speculative excess to develop and spread. In 1929, the Federal Reserve did not have the tools or the mandate that it holds today. It could not purchase assets directly, could not guarantee bank deposits, and had no formal framework for crisis intervention. The tools created after 1929 have been used repeatedly since 2008 to prevent recessions from becoming depressions, but each use of those tools adds to the total debt load carried by the United States government. The United States national debt crossed $33 trillion in 2023 and continued rising toward $35 trillion by mid-2024, a level that no major economy had ever sustained in the history of the world. In 1929, the United States was the largest creditor nation on Earth. It was owed money by countries around the world. Today, it is the largest debtor nation, owing money to countries around the world. That reversal from the world's largest creditor to the world's largest debtor over the span of less than 1 century represents one of the most significant structural shifts in global financial history. The dollar remains the world reserve currency, which gives the United States extraordinary financial power and the ability to borrow at lower rates than any other country on Earth can currently access. But reserve currency status has been lost before. The British pound sterling held that position before the United States dollar. Britain lost it gradually after World War II as its economic dominance faded. In 2023 and 2024, China, Russia, Brazil, India, and South Africa began discussing trade arrangements that would reduce their dependence on the United States dollar for international transactions between their nations. The process of shifting away from a reserve currency takes decades and does not happen suddenly, but the direction of the movement matters, and the direction in 2025 is being watched carefully by financial historians. In 1931, Britain abandoned the gold standard under the pressure of a financial crisis that had begun in Austria and spread through Germany before reaching London and threatening the entire global monetary system. When Britain left the gold standard, the financial world reorganized itself around a new set of rules. The transition was painful, disruptive, and impossible to fully predict, even by the most experienced economists of that era. The world is not on a gold standard today, but it operates under a set of financial arrangements that were built in 1944 at Bretton Woods in New Hampshire and have been slowly evolving ever since. At Bretton Woods, 44 nations gathered in a hotel in the mountains of New Hampshire and built the framework for the post-war financial system. The dollar was placed at the center of that framework. That framework has survived for over 80 years. But the economic conditions that justified placing the dollar at its center have changed substantially, and the question of what replaces it is being actively debated. The debates happening in finance ministries and central banks around the world in 2025 have a quality that reminds financial historians of the debates that took place in the years immediately surrounding 1929. A system that worked brilliantly during one set of conditions becomes strained when those conditions change. The strain accumulates quietly until it reaches a point where the system must either adapt or give way. Herbert Hoover signed the Smoot Hawley tariff bill into law on June 17, 1930. In the Oval Office of the White House, over 1,000 economists had sent him a letter urging him not to sign it. He signed it anyway. The retaliatory tariffs that followed helped transform a severe market correction into a decade-long global depression that altered the lives of hundreds of millions of people across every continent. Policy decisions made in rooms that ordinary people never enter, signed by officials that most people cannot name, can reshape the financial reality of an entire generation within the span of a few years. This is one of the central lessons of 1929. The crash was not an act of nature. It was the accumulated result of identifiable decisions made by identifiable people operating within a flawed but understandable system. Understanding those decisions does not give any person the power to time markets or predict with certainty what will happen next. But it does give something arguably more valuable, which is the ability to recognize patterns. The pattern visible in 2025 includes elevated valuations, high household debt, concentrated market power, geopolitical trade tension, rising government borrowing, and new technology driving speculative enthusiasm beyond measurable earnings. Each of those factors existed independently in years before 1929. Their convergence in the years immediately before October 1929 is what transformed individual risks into a single, catastrophic, system-wide event. Convergence is the word that financial historians use when multiple vulnerabilities align simultaneously. Each one alone can be managed. Together, they interact and amplify each other in ways that are difficult to model in advance. The economists who studied 1929 most carefully did not conclude that crashes are inevitable or that history moves in predetermined cycles. They concluded that human institutions are capable of both creating and solving these problems. Franklin Roosevelt stood before the United States Capitol building on March 4, 1933, and told the American people that the only thing they had to fear was fear itself in his first inaugural address. That speech was not just rhetoric, it was a calculated attempt to break the psychological cycle of fear that was preventing economic recovery. Long after the structural causes of the crash had begun to be addressed, confidence is not a sentiment. In financial systems, confidence is a functional component as real and as necessary as currency itself. When it disappears, even sound institutions can fail within days of its departure. The New Deal programs that followed Roosevelt's inauguration put people back to work, building bridges, highways, dams, and public buildings across the United States. The Hoover Dam stands today as a monument to that era. Not every New Deal program worked. Some were reversed by the courts, some were poorly designed. But the willingness to act, to experiment, and to treat the crisis as a solvable problem changed the national mood. The question that history leaves open is not whether another crisis will come. Financial crises have occurred in every century and in every type of economic system that human civilization has ever constructed. The question is whether the institutions, the policies, and the collective wisdom accumulated since 1929 are sufficient to prevent a repeat of the human suffering that followed the collapse of the market in that year. The people standing in bread lines outside church halls in Chicago in 1933 did not cause the crisis. They bore its weight. That asymmetry between who creates financial risk and who pays its cost is still present today. Every generation believes it has finally solved the problem of financial instability. Every generation eventually discovers that the problem has only changed its shape, not its fundamental nature or its capacity for destruction. The past still has stories to tell. Subscribe and let us uncover them together.